Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. Huge show for you today. A lot to talk about. If you're watching this on YouTube, hit that subscribe button for more content just like it. What are we going to be discussing today? So much going on. We have to talk about the new king in terms of market cap. You'll probably guess who that is. The running of the bulls. So huge increase in bullish sentiment. And for good reason. We're hitting all-time highs, seems like every single day. Investors are partying like it's 1999. A lot of parallels to the 1999-2000 period. I'm going to run through a few of them with you. The mega cap premium, talking about valuations. A lot of a big difference between the top 50 stocks in the S&P 500 and the 50 smallest in terms of market cap. Big difference in terms of their valuation. Consumer weakness or consumer strength. Interesting question. Depending on how you look at it, which data you look at, you can make an argument for either weakness or strength. Housing market, I want to give you the latest numbers there, do a quick rundown, and we'll end as we always do with something positive, and that would be the fact that inflation is trending lower. So a new king is crowned. Who am I talking about? I'm talking about NVIDIA, of course. New leader in terms of market cap. It's now the largest company in the world, market cap of $3.335 trillion, past Microsoft, past Apple this week to become the largest company in the world. And the fascinating fact, how big these three companies have become, is all three of them individually are now bigger than the combined market cap of all the companies in the Russell 2000 small cap index. So just a stunning statistic there to show you how strong large cap growth technology stocks have been. All three of these companies bigger than the entire small cap universe in the US. What's the difference in terms of NVIDIA, Microsoft, and Apple? It's a difference of expectations. So Apple and Microsoft have proven themselves. NVIDIA proven itself a lot, but still a gap here in terms of net income. Apple, $100 billion in net income. Microsoft, $86 billion. NVIDIA looking at close to $43 billion over the past year. So clearly what investors are saying in pushing NVIDIA to the top company is NVIDIA's net income is going to explode higher in the years to come. Is that going to be correct? Is it going to pass Microsoft and Apple in terms of net income? We don't know, but that is the assumption by driving that market cap to where it is today. And if we look at profit margins, you can see that huge disparity is all a function of the last few quarters for NVIDIA, where it's just making an unbelievable amount of money as a percentage of its sales. 53% profit margin. Microsoft's at 36%, and that's very high profit margin. Apple at 26%. Of course, that's very high as well. But NVIDIA really in a world of its own, 53% margin. And the question is, are competitors going to come in and take some of that margin? Like Jeff Bezos once said, your margin is my opportunity. Clearly, a lot of people are going to be gunning for those super fat profit margins. So a lot of questions about NVIDIA. Of course, it all comes down to the story, the narrative in terms of prices. But yeah, and ultimately, the weighing machine will have to come and weigh in to say, will NVIDIA grow into the valuation that it has? And so far it's done it. So far it's beaten expectations every single quarter, but expectations continue to get higher and higher. And I would say by it becoming the largest company in the world, expectations now are very, very high. So if we look at the three companies combined, we have 21% of the S&P 500 in just these three companies, Microsoft, Apple, and NVIDIA. That's the highest percentage for three companies that we've seen in history going back to 1980 for the S&P 500. So the index continues to get more and more concentrated because these are the stocks that are outperforming the rest of the market, as I'll show you later. And if we look at the top 5 stocks or look at the top 10 stocks, it's the same story. We're seeing just record highs in terms of the percentage concentration in the S&P 500. And with NVIDIA, what I like to always look at is comparing the actual fundamental expected growth with the share price growth. And you can see for the second year in a row, huge disparity here where investors are expecting that NVIDIA will grow its revenues this year 98%, but the stock is already up, and we're not even halfway through the year, already up 174%. So What this tells you is one of two things. Either those expectations for revenues are wrong, they're too low, they're going to come up in the coming quarters, or investors perhaps are getting ahead of themselves and they're assigning now a too high a multiple for Nvidia. And if we look at that multiple, looking at forward price to sales here, pretty high. In the last 2 months, we're just seeing a huge acceleration. 21 times now forward 1 year sales for Nvidia. Microsoft's at 12, Apple's at 8. So the only way you could justify this is to say Nvidia's not only going to grow a lot the next year, it's going to grow a lot the year after, and so on and so forth. And it's not just going to grow in terms of sales, it's going to grow in terms of earnings as well. And we'll see what happens. We still haven't had a quarter where Nvidia has disappointed investors. So until that happens, investors are going to be betting that Nvidia is going to continue to beat. But this is just a huge surge higher over the last few months. And so far, we don't see that accompanied with increasing expectations in terms of sales and earnings. So we'll have to see when that next quarter comes out. Were investors just getting too ahead of themselves and too optimistic, or were the analysts mistaken? And they're just going to see just an enormous beat in terms of sales and in terms of earnings. So creative planning is exciting, offering now everybody who's watching this, all the weekend charts viewers, a free wealth path analysis. All you have to do is go to creativeplanning.com/Charlie. I'll have a link in the show notes as well, and set up a call, set up a meeting. What do you get with that free wealth path analysis? You get a lot. You get a free portfolio checkup, a free retirement roadmap. We're going to look at everything within your portfolio, make sure you're positioned wisely for the future based on your goals, based on your needs. We're going to look at your retirement, say, are you in good shape to get to where you want to be? This is a huge one. We're going to look at your tax situation. We have a lot of CPAs at Creative Planning, and they look at everything. We're going to be optimizing your portfolios, figuring out, are you holding bonds and stocks in the right areas? Should you do a Roth conversion? Everything to help you save on taxes going forward. And lastly, we have a team of estate planning attorneys that will go through your entire estate plan and say, what can be improved? What do you need to change? Do you have all your documents in order? So go to creativeplanning.com/Charlie for a free wealth path analysis today. And quick rundown of creative planning. We're 300 billion assets under management and advisement. We're in all 50 states. So we likely have a location near you, and we're here to help. So reach out today, creativeplanning.com/Charlie. Number two, we got to talk about the bulls here. Running of the bulls. Why are people getting so bullish? They're getting bullish because the market just keeps going up. 31 all-time highs so far this year for the S&P 500. And that's on pace to be one of the best years in history were to continue at this pace. The S&P 500 also hit another 100-point milestone. If this sounds familiar, it's because it's the 7th of the year. So I've been reporting this frequently here. It hit 5,500 for the first time. And you can see that drought that we had during that bear market, which was 757 days between these milestones. Well, since then, we've been hitting them very quickly. It only took 8 days for the S&P 500 to go from 5,400 to 5,500. And in terms of best starts to a year, and this is now the 13th best start to a year in history for the S&P 500, up 15% through the first 117 trading days. And if we look at presidential election years, best start to a year ever for a presidential election year. In the last 25 years, only 2019 had a better start than 2024, something nobody predicted coming into the year. As I've talked about, the average strategist was actually predicting the S&P 500 would only be up 1 to 2% this year. It's already up 15%, and we're not even halfway through the year. What is this doing to sentiment? Well, as you might expect, people are getting more bullish, and they always get more bullish as prices go up. They should be doing the opposite, but it's human nature. When you're looking at the stock market, investors get more excited when prices go up, and you can see that here, 61% bulls in this Investors Intelligence newsletter survey. That compares with just 25% bulls when the S&P 500 bottomed in October 2022. And now you have the S&P 500 50% higher than back then, and you have this huge increase in bullishness. Obviously, it should be the other way around. You should be less bullish when prices are higher. You should be more bearish when prices are higher. That's not the way things work. There's very few bears today, under 18%. There were 44% back in October 2022. What does this mean for the markets? Well, what we tend to see following extreme bullish sentiment, and now we're in the top 5% of these readings, you tend to see below average future returns going forward. You can see the next 12 months, total return is around 7.7%. Looking historically, of course, over 10% for the S&P 500 on a total return 1-year basis. And the opposite tends to be true when you have extreme negative sentiment. So when there's very few bulls, like we saw in October 2022, it's usually a pretty good signal that you're going to have above average returns going forward. So we'll check this in a year, see if this was a signal of something. As you can see here, these numbers aren't negative, so it doesn't suggest that you have to have a down market, let's say, over the next few months or the next year. What it suggests is you should temper your expectations, lower the expectations. Don't assume that what's gone on in the first half of this year is going to continue going forward. That would be highly unlikely and highly unusual. Speaking of unusual, investors are really starting to party like it's 1999. That's really becoming the only parallel to what we're seeing today in a number of fronts. Number one would be the ratio of large caps to small caps. So the outperformance of large caps over the last decade, enormous outperformance. And over the past year, we've seen a huge spread this year as well. We now have the highest ratio of large caps to small caps since November 24th, 1999. You can see here, it peaked a few months before that. That was the all-time high in this ratio. And that ratio actually peaked before the dot-com bubble peak in March 2000. Now, what happened following that peak? I'm showing you that in the bottom panel here. We had reversion to the mean. You had small caps start to outperform again. They actually were up 90% over the next 7 years versus just a 10% gain for the S&P 500. So following that extreme in 1999, we saw a reversion to the mean. No one believed it would happen back then. No one likely believes it today because it's been such huge outperformance for so long, similar to the 1990s period. And if we're looking at this year, just an incredible spread between large and small. You rarely see an S&P 500 up this much with small caps down on the year. So we're looking at S&P 500 total return up over 15% on the year, with the S&P small cap ETF actually down 1.7%. Huge spread. Another way to look at this is looking at within the S&P 500 the equal weight. So instead of weighting it by market cap, you take an equal weight for all of the 500 companies in the S&P 500. If we look at that, see a huge spread here as well. S&P 500 up close to 15%, equal weight 4%. That spread 10.4% is very wide. We're looking historically here back to 1971. Only had a few years with a bigger spread. 1998, you can see 1999 was up there as well. And you had last year 2023. And we've never had consecutive years with a double-digit outperformance of S&P market cap versus equal weight. And what's driving a lot of this is the narrative that higher interest rates, the rise in interest rates over the past few years, is much worse for small cap companies than large cap companies. And there's definitely some truth to that. As we've talked about, a strange thing in terms of the Fed interest rate hiking is, so far, if we look at net in terms of net interest expense, it's actually gone down since the Fed started hiking interest rates. And that's because the largest companies are actually benefiting. So companies like Microsoft and Apple and Berkshire Hathaway have this fixed low interest rate corporate debt and not that much of it. And they have a lot of cash on their balance sheet that's now earning over 5%. So they've actually benefited. Who's been hurt are smaller companies whose debt is coming due, and now they have to refinance that debt at much higher interest rates. And if we look at the financial position of, let's say, the S&P 600 in terms of the interest coverage ratio, this is just looking at earnings before interest and taxes and dividing that by your interest expense, you can see they're in a much more difficult place than the S&P 500, 2.3 times interest coverage for small caps, 7.6 times for large caps. Now, looking at growth versus value, this would be the other comparison to the 1999-2000 period. You can see here we hit this week its highest level in terms of this ratio since July 20th, 2000. And what I'm showing you here is what happened in the next 7 years. So similar to large and small, next 7 years, we saw a reversion to the mean. We saw value stocks outperform growth stocks to an even wider extent than the large versus small. Russell 1000 value was up 84% over the next 7 years from 2000 to 2007, while growth stocks were actually down 27%. So you can see here, this ratio had its all-time high right here. We're not far from it in March 2000. And if we look at the next 7 years, just a huge, huge crash in growth stocks, hit its low here. Now, since then, growth has been outperforming value, longest period of growth outperformance that we've ever seen. Now, speaking of longest period we've ever seen, we've also seen the same situation in the US versus international stocks, which this week hit another record high, and it's now 3 standard deviations above the mean since 1970. Highly stretched here, 16 years of outperformance, longest we've ever seen, in a wide margin. So you're talking about US stocks up 5x over this period of time, and international stocks not even doubling over the last 16 years. So huge outperformance, and a lot of parallels to that 1990 period where you had outperformance in large cap growth stocks and US stocks over international. So we'll see if mean reversion isn't dead. At some point, we'll see that leadership change. Obviously, it hasn't happened just yet. Let's talk about the mega cap premium here. And this is the idea that all stocks across the S&P 500 are not the same in terms of valuation. Big dispersion depending on whether you're in the biggest stocks, so let's say the biggest 50 versus the smallest 50. But first, let's touch on the index as a whole. We're looking at the S&P 500's P ratio here. It's moved up to 25 times earnings this week, highest we've seen in a few years, well above the historical median, 18.5 times. So it's not just the case that fundamentals are improving. Yes, earnings are going up this year, but they're not going up nearly as much as prices. So prices are running ahead of earnings, driving up multiples, and we're seeing the highest multiples now that we've seen in a few years. And if we look at price to sales within the NASDAQ 100, within that growth index, the NASDAQ 100, we're seeing the highest since early 2022, 6.5 times sales. So other than that period in 2021, where we got to very elevated levels, 8.5 times, it hasn't been higher, let's say, in the last 15 years than it is today in terms of this median price to sales ratio. This is the chart I want to really dig into here. This is showing you the median price to sales ratio by market cap within the S&P 500. If you look at the 50 biggest stocks, so the Apples, Microsoft, Nvidia, Google, Amazon, these stocks, we look at the median within that group, trading at 5.6 times sales. When we look at the smallest 50 companies, 1.6 times sales. So huge disparity here. 3.5 times higher for the biggest 50 stocks than the smallest 50. And what investors have to think about is this valuation spread too high? Are investors expecting too much from the 50 biggest stocks? Are they saying that growth in revenues or over the next decade, let's say, is going to be much higher than it's actually going to be? And you can see the drop off here. It's not just the 50 biggest and 50 smallest, but when you go to 51 to 100, we're moving already down to 4 times. When you go to 150, 1 to 200, you're already down to 3 times. And so as you go down, get smaller and smaller, valuations get cheaper and cheaper. And that should be kind of to be expected given that huge disparity in terms of the performance of large caps versus equal weight and in terms of large caps versus small caps. Next, I want to talk about consumer weakness or consumer strength. This is a big question. And depending on what data point you're looking at, you really can make an argument that the US consumer is weakening or the US consumer is still strong. What would be the chart you would show if you want to say the US consumer is weakening? Well, I think this would be number one, looking at retail sales, just up 2.2% over the last year, well below the average, which is around 4.6%. But much more important, when you look at this adjusted for inflation, you actually have retail sales down 1% over the past year. So when you adjust for higher prices, consumers are pulling back at retailers, not not buying as much in terms of that quantity. So you really have to look at it on an inflation adjusted basis. Number of reasons people have suggested why retail sales have come down like this after adjusting for inflation. They're saying consumer is starting to get tapped out. That savings that they built up during the stimulus is starting to be depleted. We're seeing lower savings rates in terms of the data, so that seems to support that. And they're also saying just simply the years of high inflation, we've had 38 consecutive months of CPI being above 3%. Well, that's starting to take its toll on the consumer as well. The other argument is that consumers spent a lot of money on goods during the early stages of the stimulus and pandemic when they couldn't go anywhere. They were buying a lot of goods, and that spending has transitioned to other areas. So this would be the bullish case for the consumer, would to say, look, don't look at retail sales, look at things like spending on travel. And that is still seems to be very, very strong. And there was an interesting article in the journal talking about American tourists going to Europe and how much they're spending there is really boosting the economies of Southern Europe. So if we think about Portugal, Italy, Greece, Spain, they're seeing huge boosts to their economies from Americans going abroad. And you could see here the increases, not just from last year in terms of travels, number of flights to Europe, big increase over the past year, but a huge increase from 2019 as well. So a lot of pent up demand for travel, and it still doesn't seem to be the case that everyone has done the trips that they've wanted to do that they didn't do in 2020 and 2021. Still a lot of pent up demand, and that would suggest, since these trips obviously aren't cheap, going to Europe, not a cheap trip by any means, and they seem to be spending a lot of money when they go there. Well, that would suggest the U.S. consumer is still doing well, definitely, I guess, on the high end of things. So if we look at how this is all expected to filter out into second quarter GDP, real GDP, what the Atlanta Fed, their latest estimate is saying is we're going to be about 3%. And I think if that's actually the case, that would be well above what people are expecting here. You can see Wall Street is expecting around 2%, and a lot of people are thinking it might even come in lower than that. So if the Atlanta Fed is correct and that 3% number is right, I think that would be definitely an upside surprise, and certainly suggests that consumer weakness is not yet impacting the economy if we get another 3% number. Okay, let's talk about the housing market and do a rundown here. A lot of data points we got this week. First, home builder sentiment back on the downswing here. We're looking at lowest number for the year. This is essentially a poll asking home builders, are they confident? Are they saying conditions are good or poor? And more are saying now that conditions are poor. Lowest number of the year at 43. What that's translating to is builders aren't building as much. And there's two reasons for that. One, financing costs are still very high, putting stress if they're looking to finance the cost of construction, which many of them do. And two would be the fact that they're still saying, well, the buyer is tapped out. The buyer can't afford this house because the price is too high and mortgage rates are too high. So it's really a function of higher financing costs, higher mortgage rates. And we could see what that's doing to housing starts here. They're actually down 19% over the past year and at a 47-month low. So builders not building, it's almost a 4-year low. You have to go back to the 2020 COVID period to see a lower number for housing starts. And that's not good news for the housing market because we need more supply in the housing market. And now it doesn't seem like we're going to be getting it from new construction. We'll have to be relying on existing home sales. So existing home supply. So let's take a look at that. Existing home sales were actually down once again on a year-over-year basis, down 3% over the past year. That was the 33rd consecutive year-over-year decline, the longest downturn in terms of activity for the housing market that we've seen since 2006 to 2009. So you have to go back to this period here to find a longer stretch where home sales were down on a year-over-year basis for longer than today. And if we look at the bright spot, I would say, in terms of the report, it's that existing home supply is starting to creep up very slowly. So I don't want to make a huge deal about it, but definitely a noticeable difference from where we were 2 years ago And even last year, we're seeing an increase in supply. So now we have 3.7 months worth of supply for existing homes. That's the highest we've seen in a few years. And if we look at the real-time data out of Redfin, they're showing active listings of homes at the highest levels that we've seen in a few years as well, and up 16.5% year over year. So we're seeing more listings. The listings seem to be taking longer to sell. We're seeing more price reductions in terms of people are cutting prices in order to try to get that house sold. And we're starting to see signs in certain areas of a cooling in terms of prices. I guess Florida would be the area number one that people are starting to look at because it was one of the hottest areas in the country for a long time. And now it's starting to finally cool off. And a big reason for that is that we're seeing an increase in inventories. Here's 3 areas within Florida: Northport, Tampa, and Cape Coral are all seeing huge inventory increases over the past year, and that's starting to put pressure on prices. You can see over here. So we'll see what the impact of that is, if that starts to be more of a national thing. So far, it's more local. We're seeing it in Florida. We're seeing it in Texas. We're seeing some of the areas that have had more building, let's say, in recent years, start to have an increase in inventories. But overall, because supply is still so low, we've actually seen prices continue to go up. We saw a new high in terms of the median sales price for existing homes in May, and it surpassed the previous record from June 2022. So a new high in terms of prices. And why are prices going up? It's simply inventories are still so low that even though demand has been crushed and there's very little demand, supply is still so low that you have prices rising. And let's talk about affordability here. Prices obviously hitting record highs. That's not good for affordability. And number two would be the mortgage rate. We're at 6.9%. You can see here where we were a few years ago, below 3%. And I do this comparison a lot, but I want to do it once again here, looking at 4 years ago versus today, looking at the housing market. So 4 years ago, we had a 30-year mortgage rate at 3.1%, and the median price of an existing home was $284,000. Today, you have a 30-year mortgage rate more than double the rate from 4 years ago. You're at 6.9%. Yet you have the price much, much higher at $419,000. And what this means, and this is why demand has been crushed, what this means is you would need a $27,000 more in order to have a down payment if you're putting 20% down. And your monthly payment, this is the big one, is 128% higher than it was 4 years ago. So this would be the number one reason, because people's incomes have not gone up 128% over the last 4 years. You'd be lucky if they've gone up 20%, because that's probably about the average. So housing is unaffordable to many new home buyers, and that's why we have the situation we're in, where we're just seeing a lack of demand and a lack of supply. But hopefully that supply picture is starting to change here. Hopefully we're going to see a tick up in supply, and we'll start to see a moderation in terms of prices. The mortgage rate, nobody can predict where that's going, but given the unaffordability, you would say that the only way we're going to get there is for mortgage rates to go lower or for home prices to go lower. And which one of those two is going to happen first, that remains to be seen. But I want to focus on that supply number and say that's good news, and hopefully it'll continue to trend higher in the months to come. Okay. I want to end, as I always do, with something positive, and that's inflation trending lower. We're looking at a few things here. First, I want to start with the Manheim used car index. This is wholesale used car prices, lowest levels we've seen since March 2021. This is a mid-month update for June, so should be good news for the CPI report in terms of that component, used car component. And we're now well over 20% below the peak and trending in the right direction. So higher interest rates are doing what they were supposed to do, which was really bring down demand. And that's very slowly here, but it's bringing down prices. And so this is a leading indicator of retail used car prices. So I expect in the next couple of weeks, next couple of months, we'll see retail prices continue to trend lower as well. What are we going to see for June CPI? Well, the Cleveland Fed's usually pretty close in terms of their projections here. They're saying it's going to drop down to 3.1%. It was 3.3% in May. They're thinking core CPI is going to trend lower as well, moving down to 3.5%. And PCE, core PCE, they're saying is going to continue to trend lower as well. If we look at real-time inflation, we know that the CPI has many lagging components to it. Better read on perhaps on real-time inflation data would be looking at the way Trueflation tries to calculate it. And what they're saying is 2.1% now over the last year for the actual US inflation rate. So if you believe their number, that's trending in the right direction here. Obviously, the Fed wants to get back to 2%. CPI is still above 3%, but if you're looking at the way Trueflation does it, they're saying we're essentially already there. So I want to end right there. And thank you for everyone for joining me this week on the Weekend Charts. Take a moment, if you're watching this on YouTube, hit that subscribe button, hit that like button, leave a comment, and have an awesome weekend. And I'll see you next time on the Weekend Charts.